Figma, the cloud-based collaborative design platform that became a household name in the creative and tech communities, has recently released its first quarterly earnings report since its IPO, and the results sent shockwaves through Wall Street. What was once celebrated as one of the hottest SaaS listings of 2024, soaring to a peak IPO price of $142.92, has now faced a harsh reality check. The stock plunged nearly 20% in a single day, landing at $54.56, marking a 60% plus decline from its high. Figma has long been praised for its innovative approach to product collaboration. It's more than just a design tool. It has become a central hub where designers, engineers, and product managers can work seamlessly together in real time. From vector graphics and UI/UX design to prototyping and developer handoff, Figma positioned itself as an indispensable tool for teams globally. Its ease of use, cloud-first platform, and real-time collaboration capabilities helped it amass a devoted user base, ranging from freelancers to enterprise clients. The company's growth trajectory was further accelerated by the AI revolution. With recent launches such as Figma Make, Sites, FigJam AI, and Dev Mode, the platform promised to supercharge productivity and reduce design bottlenecks. Investors were captivated by Figma's potential to integrate AI across the creative workflow, seeing it as a SaaS play that could rival or even surpass competitors in design, collaboration, and AI-driven creativity. Despite this promise, Figma's first earnings report has highlighted the challenges of living up to sky-high expectations. Investors anticipated strong revenue growth coupled with positive earnings per share, and even minor misses triggered disproportionate market reactions. The stark stock decline reflects the market's sensitivity to execution risk, profitability, and whether Figma can maintain its rapid growth as the SaaS sector evolves. In this long-form video, we will break down why Figma's earnings disappointed, the detailed numbers, market reactions, guidance, analyst verdicts, and the broader implications for the company and investors. Each slide will provide a comprehensive view of Figma's performance, from the headline shock to deeper financial and strategic analysis. Figma's second quarter earnings report surprised investors, but not in a positive way. The company reported results that fell just short of expectations, and the stock reaction was swift and severe. On the day of the earnings release, Figma's stock price plummeted nearly 20%, a dramatic move for a company that had only recently completed its IPO at a peak price of $142.92. The closing price of $54.56 reflects both investor disappointment and broader skepticism about sustaining growth at its current valuation. The market shock stems from multiple factors. First, investors have grown accustomed to SaaS companies, delivering both rapid revenue growth and visible path to profitability. While Figma's revenue showed impressive year-over-year growth, it just missed analyst estimates, which became a tipping point given the elevated expectations from a highly hyped IPO. The stock's fall illustrates a key lesson. Even small deviations from expectations can trigger outsized market reactions, especially in companies with high valuations and limited earnings history. Second, Figma's stock was priced at a premium due to strong narrative momentum. Investors were betting not only on revenue growth, but also on the company's strategic position in the AI-driven design space. The hype surrounding AI-powered productivity tools elevated expectations for both near-term and long-term performance. In that context, a slight earnings miss and flat EPS caused investors to reassess their optimism, sparking a rapid sell-off. Finally, the shock also reflects psychological dynamics in the market. Investors tend to anchor on IPO highs and projected growth, making even minor discrepancies appear catastrophic. The dramatic headline of a 20% single-day decline dominated media coverage, reinforcing the narrative of a stock meltdown and creating a feedback loop of negative sentiment. In short, Slide 1 establishes the context. Figma's first earnings report has jolted the market, illustrating the tension between hype, execution, and investor expectations. It sets the stage for deeper analysis of the financials, guidance, and market reaction in the following slides. At first glance, Figma's numbers are solid but not stellar. The company reported revenue of $249.6 million, which represents 41% year-over-year growth. This is a strong performance, particularly for a SaaS company in the competitive design and collaboration market. However, it came in just under analyst estimates of $250 million, highlighting a gap between expectations and actual performance. EPS, earnings per share, is a critical metric for investors assessing profitability. Figma reported an EPS of $0, while analysts had expected $0.09. Flat earnings suggest that while revenue is growing, expenses and investments are high, particularly in AI initiatives, infrastructure, and customer acquisition. For a premium SaaS stock, this flat EPS disappointed investors who had priced in a more immediate profitability trajectory. Another key metric is net revenue retention, NRR, which measures the company's ability to retain and expand revenue from existing customers. Figma reported NRR of 129%, a solid figure indicating that existing enterprise customers are increasing spending on the platform. However, it represents a slight decline from 132% in the prior period, signaling modest slowing in expansion within the existing customer base. Figma's enterprise customer growth is also notable. The company now has 1,119 customers paying $100,000 plus annually, up from 1,031 in the previous period. This indicates that Figma continues to gain traction among large organizations, demonstrating that its platform is valued by enterprise teams for design collaboration and AI integration. The combination of strong revenue growth, flat EPS, and slightly declining NRR underscores a mixed picture. On one hand, Figma is scaling, maintaining customer loyalty, and expanding enterprise adoption. On the other, investors are wary that the profitability path is delayed and that high expectations, especially tied to AI and workflow expansion, are putting pressure on the stock. Looking forward, Figma provided guidance for Q3 and FY25. The company expects Q3 revenue between $263 million and $265 million, representing 33% year-over-year growth. For the full fiscal year 2025, revenue is projected between $1.021 billion and $1.025 billion, a 37% increase from the previous year. At face value, these projections signal continued growth, albeit at a slightly slower pace than earlier quarters fueled by AI-related excitement. Investors were hoping for more aggressive guidance that would justify Figma's premium valuation, which has been elevated due to its AI integrations and dominant collaborative platform narrative. Analysts and market participants are particularly focused on sustainability and scalability of growth. After strong adoption of AI-driven tools like Figma Make, Sites, FigJam AI, and Dev Mode in Q1/Q2, there is concern about whether the same level of enthusiasm and spending will continue in subsequent quarters. Additionally, enterprise adoption cycles can slow as customers integrate existing tools before expanding further, introducing natural deceleration in revenue growth. The guidance highlights Figma's balancing act, investing heavily in innovation, AI, and infrastructure while trying to maintain strong revenue growth and move towards profitability. This tension is common for SaaS companies trading at high multiples. Investor patience is tested when growth remains strong but not enough to justify lofty expectations. Wall Street's reaction to Figma's earnings has been cautious. Most analysts maintain neutral ratings, reflecting uncertainty about near-term profitability and high valuation risk. Price targets range widely. Goldman Sachs, $48. JP Morgan, $65. RBC, $75. Morgan Stanley, $80. One of the key factors in the cautious outlook is valuation. Figma currently trades at roughly 32 times 2026 revenue, a significant premium compared to roughly 10 times for typical SaaS peers. While growth remains strong, the market is questioning whether the current valuation can be sustained, given slower than expected EPS growth and slightly moderated NRR. Analysts acknowledge Figma's strategic positioning and AI integration, which could lead to long-term market dominance in design and collaboration software. However, there's recognition that investor expectations are extremely high, and any misstep or perceived slowdown can result in sharp stock declines. The verdict is clear. Figma is still a market leader in collaborative design, but premium valuations carry higher risks, especially when trading on narratives tied to AI adoption and product innovation. Wall Street is now watching execution, enterprise adoption, and AI integration effectiveness more closely than ever. Figma's story is about more than numbers. While the earnings report sparked a short-term stock meltdown, The company remains a critical platform in the design and collaboration ecosystem. Figma is transforming the way teams work, moving beyond traditional design software to become a full product collaboration platform. Its AI initiatives, such as Figma Make, Sites, FigJam AI, and Dev Mode, signal a strategic bet on automation, efficiency, and AI-augmented design workflows. These tools allow designers, product managers, and engineers to create, iterate, and deploy designs faster while maintaining collaboration and oversight. The potential market for AI-driven design and product collaboration is vast, spanning startups to Fortune 500 companies. The earnings report also serves as a lesson for investors. Even highly hyped SaaS companies with strong growth and compelling narratives face market scrutiny if earnings and growth do not meet lofty expectations. Valuation discipline, execution, and sustainable growth metrics remain central to investor confidence. In the bigger picture, Figma's platform continues to see enterprise adoption growth, expanding AI capabilities, and solid net revenue retention, positioning it well for long-term relevance. The challenge will be managing expectations, maintaining high growth rates, and delivering profitability over time. While the stock may have sold off sharply, the underlying business and strategic trajectory suggest that Figma is still on a path toward building a dominant AI-enhanced collaboration ecosystem.